Hey guys, thank you so much for joining me. We are going to be talking about options basics, basically the fundamentals of options trading. My name is Kirk with Tactical Options Trading, and we make videos just like this all the time where we talk about the stock market and options trading. So if you're interested in learning more, I hope you'll consider subscribing. All right guys, let's get started. So we're talking about options basics, and this video is basically going to be a quick guide to understanding options trading. So a couple of key points to remember about options is that option contracts control 100 shares of the underlying stock. So let's say, for example, you bought a call option on Apple. Well, that call option would give you the right to control 100 shares of Apple stock. Now, every option contract has an expiration day. And so depending on if you bought a monthly option or a weekly option, they're going to have different expiration days. So typically, if you're going to buy the standard monthly option, that expiration day will be on the third Friday of every month. Now, technically, it is on the following Saturday right here, the next day at 11:59 a.m. But because we cannot trade on Saturday, and as options traders, we can only trade during market hours for options, that will be on Friday afternoon when market closes. So that's option expiration Friday, is that third Friday of every month. Now, if you're trading weekly options, you're going to have an option expiration every week, depending on what series you purchase. Now, when you purchase an option, let's say again on that call option on Apple, you're going to pay a premium to be able to control those 100 shares. So you pay that up front, and that gives you the right to control those shares of stock. All right. Now we're going to be talking about buying options in this video, and in a future video we'll be talking about selling options, but we're going to be talking about buying options today, and we're going to first talk about the call option. So when you buy a call option, that gives you the right to buy stock. So a single stock option gives the buyer the right, but not the obligation to purchase 100 shares of the underlying stock for a set price. And that set price is called the strike price. So call options are limited by time, of course, and we talked about option expiration. So all options expire, and we got to know when that option expiration day is. So let's talk about the call option. So what I like to do is give this in the form of an example of a house. So let's say, for example, this home here is worth $100,000, and we think as the buyer that this value of this home is going to increase over the next 2 years. So let's say we approach the owner of the house and we strike an agreement with the homeowner that we have the option to purchase this home for a set price of $100,000 anytime in the future before our contract expires, and we paid a premium of $10,000 for that right. All right. So just as we thought, over the next 2 years, this home's value increased from $100,000 to $200,000. Yay for us as the option holder, correct? So if this were the case, we as the option buyer, or the person who holds that contract, we have the right to control that property. We have the right to control the stock in this case, or in the property in this case. So we could exercise our right via the contract and purchase this home at the agreed upon price of $100,000. And then if we so choose, we could sell that home on the open market for $200,000. Now that would net us a profit of $90,000 because we remember we paid a $10,000 premium to control this property. So at the end of the day, we would have a $90,000 profit. So again, the call option gives us the right to buy stock. Now, in the options world, most options traders would not exercise their right to purchase the stock and then just resell it. That's a lot of hassle to go through. But most option traders, all they're going to do is just sell their contract, because their contract now has gained some intrinsic value. It has gained value because that stock, or house in this case, has gained value. Therefore, the contract has gained value, so they can sell that contract on the market. So this is the basic call option, and it got its name because of the nature of the contract. So as the buyer, so example, in this case where we're talking about this house, as the buyer, we could call that stock or call that house away from the seller. So in the example of a stock, we would just call that stock away from the seller of that option contract. So what's the risk in trading a call option? Well, what's the risk when you're buying an option, I should say. So when you're buying an option, you pay that premium. So in the example of the home, if the home had not increased in value, then we as the option buyer would just lose the premium that we paid up front to have that right. So that would be our max loss. The premium that we paid would be our max loss. So in the case of buying that home, our max loss would be $10,000. So if that home did not rise in value, and let's say it decreased in value to $90,000, we would not want to exercise our right to buy that house at $100,000 because, well, that wouldn't make sense. So we would just let that option contract expire, and the option seller, the owner of that house, would just, keep that premium. So there wouldn't be, we wouldn't have to, we wouldn't exercise that right to buy that property. So in the example that we just talked about, that's really an example of a covered call, because as the seller in this case already owned the stock or house, but if he did not already own the stock, he would have to buy the stock or house on the open market for $200,000 and then deliver it to the option buyer at a $100,000 loss. So when you're selling options, you don't have to actually own the stock. So let's say, for example, going back to the house, the seller would not actually have to own the house before he could sell it. But if we did exercise that right, that seller would then have to actually go out in the market and buy that house, or if he was selling options, he'd have to buy that option and then sell it to us at a lower price. But in this example, he owned the house, so it's a covered call, so he would just give us the house. But if he didn't, he would then have to go purchase that stock to sell it to us at a lower value. Now, trading naked call options, as you'd call it, because you don't have any protection, has unlimited risk due to the stock being able to rise indefinitely. So the stock price could go indefinitely, which would cause a unlimited risk to the seller in selling a call option. So we're going to talk about that again in another video when we're talking about selling options. All right, now let's talk about a put. So when we're buying a put, that gives us the right to sell stock. So buying a put option gives you the right to sell a given stock at a certain price by a certain time. For that privilege, again, we pay a premium to the seller, and that's called a writer of the put, who assumes the downside risk and is obligated to buy the stock from us at a predetermined price. So again, we'll use the house example. Let's say the homeowner in this example expected that his home that is now worth $150,000, he expected it to lose value over the next 2 years. Let's say he knew a hurricane season was coming, and he was afraid that his house was going to be a total loss, or and this was you think of a put option as an insurance contract. So so the homeowner in this case was expecting his home value to go down over the next 2 years for whatever reason. And so he went out and bought a put option, basically an insurance policy that stated that if his home did lose value over the next 2 years, he would be able to sell his home for the price that it is worth today. So we're talking about buying a put option here. All right, so 2 years goes by, and sure enough, the home did lose value, and his home that was once worth $150,000 is now only worth $100,000. So the homeowner could now exercise his right to sell his home at an agreed upon price of $150,000. Remember, he bought a put, and that gave him the right to sell stock, or in this case, the right to sell his home at the agreed upon price of $150,000. So in the options world, this would be a put option, and many use this technique to hedge against the stock market. So let's say you own a bunch of stock and you expected the market to kind of go down. Well, you could buy a protective put. You could buy a put that would gain value if that market or that stock went down, to kind of hedge against any losses. And as an options trader, we don't have to own the stock to buy a put option, but owning a put option gives you the right to go and purchase the stock on the open market at the lower price and then sell it or put it to the seller of the option at that higher price. So when we bought that put option as a buyer, that gives us the right to sell stock. So let's say we agreed on that we agreed on $150 was our strike price, and that stock is now trading at $100. Well, if we bought that put option, that would now give us the right to go out and buy that stock at $100 and then put that stock to the seller of that put at $150, therefore making us a profit because we bought it low and sold it high because we had the right to sell that stock. Now I know we're talking on the put side here, and you know, you kind of have to think about it because a lot of this stuff you really have to kind of put some time into thinking about it to make it really to kind of make it make sense to you. If you start thinking about it, it'll come though. I want you to know it'll come. So again, however, most option traders are not going to go out and purchase the stock on the open market just to sell it or put it to the seller at a higher price. They'll just sell the contract as the contract now has gained value. Again, they're not going to go out and buy that stock at the stock price. They're just going to sell their option contract. Guys, I hope this video has been helpful to you. It was just a quick video on understanding buying calls and buying puts, and understanding that each option that we buy has an expiration date. You know, there's an expiration date with every option, and they close, or that expiration date if you're trading regular options is the third Friday of every month. So quick video, but I hope you guys enjoyed it. Thank you so much for watching, and if you liked it, please give it a thumbs up, and if you think this video could help someone, we'd love for you to share it. Again, my name's Kirk with Tactical Options Trading. If you enjoy this kind of stuff, I hope you'll consider subscribing. Thank you again so much for watching. We'll catch you next time. See ya.